Alright, ICT traders, welcome back to the channel. This particular question I'm about to address in this particular video has been addressed to me so many times. I cannot count the number of times this question was asked. ICT 2022 buy and sell model. So what I want to do in this video is to just give you a summary of what it is and how to practically use it. Alright, so let's get into the video. Now, for those of you who are new to ICT concepts, don't worry, I have you covered. I have a dedicated YouTube channel where I started teaching ICT concepts and I'm trying to arrange them sequentially. I'm starting from the beginner's basics, intermediate, and then advanced level. You can find it right here. The link to this particular YouTube channel will be placed in the description of this video. All you have to do is to click on it and subscribe here and come to playlist right here and start from the beginning. You can actually see we are still treating ICT core basics. We have just finished ICT institutional reference point. I'm going to arrange it in such a way that after watching, you'll be okay to trade as a professional. All right, so let's get into ICT 2022 buy and sell model. I will make this video specifically for just the buy model, and then I will make another video for the sell model. All right, so in summary, whenever you hear about a buy model, it means the market is in an uptrend or it has changed direction to a bullish movement. All right, now the beauty of this concept is that you can use this concept for a long-term trading or a positional trading or even a short-term trading. All right, remember from the beginning, you will understand that market has basically three directions: consolidation, uptrend, and downtrend. Now, for those of you who are already advanced in ICT concept, you have to be patient with us right here because this is an educational YouTube channel. I would like to go over and over, and I love teaching this. All right, so this is it in summary. All right, you need to have this understanding. There is something I call the sellers and buyers territory. All right, sellers territory and buyers territory. Now, sellers territory is when you have market moving in a downward direction. As far as you keep having this series of lower highs and lower lows, as far as this thing continues in a downward direction, this is considered as a seller's territory. Seller's territory. Please don't forget this. Now, let me give you one secret of trading. Every time you are trading, don't ever assume that market will turn direction. If market is going in a downward direction, keep selling. Even if that downward movement will reach 2 years, keep selling. Don't see this kind of movement because price has reached this place from here. Price has moved from here to here and you just assumed that market has finished movement. Let me start buying from here. And look at what happened. Movement continued to this place. All right, so don't ever make an assumption in this market. If the market is telling you I want to keep selling, my brother. If the market is telling you I want to keep going up, keep buying. All right, that is the first secret. So this is seller's territory. The only time that we will conquer seller's territory, you have to pay attention to this lower high. Your lower high is your most important thing if you're dealing with seller's territory. Every time price decides to conquer seller's territory, it will start by taking out the last lower high before we can completely say that we are now in buyer's territory. All right, so this is what ICT calls shift in market structure, and other people call it change of character. Whichever way you want to call it, it is basically change from seller's territory to buyer's territory. All right, so this is where ICT came up with the concept of buy model and sell model. All right, now remember where did I keep those things? I deleted some of those things, those write-ups that are very important. All right, there are three basic things you need in order to fully understand this. You have to define your bias. The bias is simply where the market is going right at that point. Look at this. For you to have a buy model, you need a sell movement, a downward movement, and you will keep paying attention on the lower high. The lower high is your most important thing. All right, especially if you want to do long-term trading. All right, whether you're doing long-term trading or short-term trading. For some people, they will just look out for liquidity residing below, the sell side liquidity or the buy side liquidity. But in this regard, you're going to watch out for this. This is one of the most important things. Your lower high, LH. So as price keeps coming down, this is your lower high. Look at what happened. Your lower high here was conquered at this point. Does this ring something in your mind? What happens to your buyers from coming down? Assuming you have a strong security guard here, and this security guard was conquered. The only way you will know this security guard was conquered is when you see the candle push outside and closes with the body outside the highest level of this security guard. All right. Notice how this candle came and closed inside of it, couldn't close above it, and then gathered another momentum and push above it. I hope this is understandable enough. So when you have this shift in market structure from downward bias, this is how you're going to see it. Because this is real market. You are not dealing with a replay, all right? I love doing this. I love teaching this because it makes it easy. And now look at this. What do you think the market is after? The market is always after money. Don't call it liquidity, call it money. All right? The smart money, they are always after money. And every time you see price create this low, what do you think is below here is money. If it pushes below it, what do you think price grabbed is money? Right here, there are two things you will look out for you to have a proper buy model. A sweep of liquidity and a shift in market structure. All right? A sweep of liquidity and a shift of market structure. Don't forget, sweep of the money below here, and they are tired of the money they are fetching from here. All this while, they are fetching money below here, below here, below here, and they have fetched all the money that there is. If you will zoom in this, you will discover that from a long-term perspective, the money was, look at it. Can you see this cursor? All this money, if you bring it like this, all the money was fetched, and now there is no longer any money here. And these guys are ready to change their movement. All right? They want to conquer the sell territory and now turn to be buyers. So what we do as traders is to use our understanding of smart money concept and trade alongside them. We don't trade against them. Okay? So look at this. Fetching money below here. All this one is money. Money, 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 money. And don't make a mistake and think that this place doesn't have money. Money is also here. All these places. Money is also here. All right? Money resides below relative equal lows and above relative equal highs. This is where the money is residing. So they fetch this one and they fetch this one. And this is how you call a market structure shift a valid one. So now, after the sweep of liquidity and a shift of market structure, what do you look out for? Imbalance. This imbalance is important. Look at this. Can you see a fair value gap? Okay, an imbalance is what ICT calls a fair value gap. Another name for a fair value gap, rather, is an imbalance in price action. And it is simply this one. Let me show you. I don't want to go into explaining that because this is too basic. If you're starting out ICT, please go and start from that YouTube channel. You will understand what fair value gap is. All right? Look at this fair value gap. The gap between the high of this candle and the low of this third candle, 1, 2, 3. This gap is what is called your imbalance. So if you want to do buy model, you must have these three things: sweep of liquidity, shift in market structure, imbalance. To further fortify this imbalance, we have a bullish order block close to it. If I see this, I would love to take trade with that. If I'm doing long-term trade, then this is my goal. All right. Now, there are two ways you can do this buy model properly. You can decide to go down to the lower time frame and watch out for this retracement, or you can take it from the time frame you're watching. Whichever way you want to do it. I want to just give you summary and simplify it. So going back to the 1 hour time frame, I want to watch price come to that area and see some certain rejection from there, and then I can take my trade, because obviously we have shifted structure after sweep of liquidity. Can you see price is coming back to my imbalance? Price is coming back to my imbalance. Can you see? Rejection is telling me that something is happening. All right? It's telling me that something is happening. And this is something you can do even in the lower time frame. All right? Something you can do even in the lower time frame. 15 minutes. Can you see? 15 minutes came to that same area and hit this area and bounced back. Looking at it, okay, looking at it happening. What do you see? Consolidation. Oh, I wish I can teach you this for a long time. All right, I will have another time to teach that. I love something really here that I'm seeing happening. Okay, in the lower time frame now, look at this. Another shift in market structure in the upward direction, right there, and another imbalance. Very powerful concept, guys, right here. So if you're struggling with entry, where is your entry going to be? To me, it's this imbalance in the lower time frame. These things are easy to understand, right here. And where is your stop loss? Below here, right here. Where's your target? The opposing liquidity. And that is the buy model. All right? It's as simple as that. Shout out to ICT. You can go to ICT YouTube channel and watch more of these videos too. What I'm doing is just to simplify some of these things for you. All right? So let's watch it and see how it plays out. So this is the buy model, guys. Okay? If you do this, I assure you the only thing that is needed for you in this market is trading psychology. It's your trading psychology that you need to work on. What did you fetch? You fetched this trade. As easy and simple as that. All right? So going back to that, let's see another example and see how we are going to do with this. All right? Dealing only with buy model. Please don't forget, with buy model. We have another buy model here. Market is doing its downward movement. I told you, don't ever assume that this thing have sold so much. Let me turn to be a buyer. Until the market gives you an indication that I want to be a buyer, you don't become a buyer. You keep selling, seller's territory. Where did we become buyers? Here, right above here. What did you see here? Sweeping liquidity, this place. Sweeping all the liquidity here. If you should zoom this thing in, you're going to see where it is. Can you see? All the liquidity below here. It came here and sweep it. And then this guy is turning direction from here and upward. Look at this. Coming from this short-term change of direction and movement. So look at what we have here. The most important area we have right here. Okay. If you can use this for long-term trading, it's going to be really perfect. All right. So look at this. Price swept liquidity and shifted market structure. Did you see this one? This is a lower high. Remember our LH? Don't forget our LH. Our LH is where our reference point is, and we closed above it. And what did we have after closing above our LH? We have an imbalance. The high of this candle and the low of this candle. All right? We have an imbalance right here. an imbalance. Now, when you see a very big imbalance, what you do, there is something called consequent encroachment taught by ICT. Shout out to ICT. CE. CE is when you pick your line and put it here, right there, and measure this to here. 50% of a very big fair value gap is what ICT calls consequent encroachment. All these terms are, let me simplify it. Just 50% of a fair value gap is what is called CE, consequent encroachment. All right, these terms are too big for some people. All right, so look at this. We have this. How do? We enter trade here, either in the lower time frame, or if you have the confidence and a big account size to take it from the time frame you're watching it, it's fine. All right, but the lower time frame will actually give you something I call the rhythm of the market. It will break it down into knots, and then you will have it into crunches. You will see every detail in reality. So this is it. Price came back, and our consequent encroachment is important now. We used our consequent encroachment in a very big fair value gap is when you will use consequent encroachment. And I think this is understandable enough. You can break down this into the lower time frame just like the first one I showed you. I don't want to go too far into explaining this because I will make another video for the sell model. This is for the buy model. I think I will stop from here, guys. If you love this video, don't forget, guys, give us a like and subscribe to this YouTube channel. Let's reach 100K within the shortest time, and let's see how it is going to be. Thank you guys for watching. See you in another